Absolutely brutal. Inflation up and equities down and down hard. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, we begin with the big issue. Inflation coming in hot. A 40-year high on core CPI, giving the Fed a green light to keep on hiking. With the market action, here's Katie Lyons. Hey, Kaylee.
John, absolutely brutal out there. We have seen a re-rating of the terminal rate expectations. Now swaps pricing in 4.85% when all is said and done this cycle. And that means yields are absolutely flying. Specifically at the short end on the 2-year, we're up 19 basis points on the day, 448. This is the highest we have seen going back to the summer of 2007. So basically, John, no, we had not peaked on the short end already. And at the longer end of the curve, the 10-year up 14 basis points north of 4% at 4.04. And of course, when you have yields moving higher, those higher borrowing costs weigh heavily on equities. We are seeing S&P futures dropping like a rock after the print, now down 2%. It's even worse for NASDAQ 100 futures, which are down now about 3 percentage points, given those are more richly valued stocks. So you want to steal stocks, you want to steal bonds after this. The only thing anyone really seems to be buying is the dollar. The Bloomberg Dollar Index is back up toward record highs. It's essentially destroying everything in G10 right now, barring the British pound, which of course is related to UK policy and is a separate issue. But the dollar really gaining strength here. And John, just pour one out for the Japanese yen, right now trading at 147.35. These are levels we have not seen since crisis era, all the way back in 1998. And that is even above the levels we had already seen Japan policymakers intervening to stem the weakness in the currency. Post CPI today, that is just continuing because the BOJ is going nowhere. And this market is betting that the Fed is going to go even further than it already thought.
They don't need shots, they need a bottle. Yeah. Kelly Lyons, thank you. Kelly on the latest with the price action. Mike McKee down in Washington. Mike, put it all together. You've had 30 minutes to reflect. Your thoughts?
It's ugly, and there isn't much more you can say about that. Now, the Fed knows it's going to take a long time to start bringing inflation down, but I think they were hoping it wouldn't start going back up again. Now we've got 8.2% headline, 6.6% core on a year-over-year basis, and it's that core number that's scaring the markets, and it's going to make the Fed think twice about how quickly it needs to move. The biggest movers in the CPI this time, gasoline down 4.9%, still up by 18.2% for the year. Food at home up 0.7, 13% for the year, and those are two things that Americans are going to notice. And the problem with gasoline is it's going to go back up again. Owner's equivalent rent up 0.8. That's an increase from the last 4 to 6 months, and it's up 6.7%. So housing, a major component of the CPI, about 1/3 of it, and it is putting a lot of upward pressure on the core. Used cars did drop 1.1%. We've been waiting for that. Still up 7.2% on the year, and apparel down 0.3. Interesting, you look at the apparel category, and just about everything went down in price. There are a lot of sales. Inventories are high at retailers, so we should expect to see continued drops there. There were some surprises, though. I mentioned gasoline goes down, but natural gas goes up by 2.9%, and it's not even winter yet. This may be because there's a bit of a shortage of gas as we sell a lot overseas, so it could become a political issue. And of course, as it gets colder, it'll become an issue for voters. Airline fares supposed to drop as the summer travel season over, up by 0.8, and medical care 1% higher. There is some thought that that may drop off. Methodological changes are coming into force next month, so if that drops, that would be a big help. But the real question is, how high does the Fed go? They've never had a tightening cycle where they didn't go over the level of inflation. Right now, they're raising rates, but inflation's still going up. So they aren't able to close that gap, John.
What a tough spot. Mike McKee down in D.C. Mike, thank you. This inflation print hijacking the conversation, the debate down in Washington. Mike talked about this becoming political. It is right now. It's the last CPI report before the midterms. Later this hour, the view from the White House with Brian Deese, the National Economic Council Director, coming up a little bit later. Let's get to the guests. Morgan Stanley's Jim Kerr and Mona Mahajan of Edward Jones. Mona, first to you. Your thoughts on this one?
Yeah, John, look, this is presenting a real challenge for not only the Fed, but the broader economy here. You know, inflation was supposed to be moderating. We were looking for 2 to 3, maybe 4 prints lower. In fact, today we got a print that is moving in the wrong direction. Of course, what we're seeing is this repricing in markets. The Fed, market expectations for the Fed now 100 basis points on the table for November, December looking for another 75. And perhaps after that, we start to see a bit of moderation in Fed rate hikes. Now, keep in mind what we're watching for, of course, with such dramatic moves in yields. Will we face any sort of liquidity issues? Some of the credit disruptions we saw in UK, could they come here to the U.S. shore? That's something to keep an eye out on in the weeks ahead, of course. But I think generally, although this print was very disappointing, one thing we are watching are the underlying fundamentals. Yes, shelter and rent in the CPI are moving higher, but when you look at underlying fundamentals in mortgage rates, in housing, in broader rental markets, we're actually seeing the opposite trend. There is a lag impact. And so over time, we do expect those components to moderate as well. It seems like it's taking a bit longer than expected.
Hey, Jim, this is brutal.
It is brutal. I think that's a good way to sum it up. I mean, look, you know, we're in a situation here where we thought the Fed had made a one-off adjustment to get to the policy rates up to 4.75%, and the markets mainly thought game would be over at that point, and now it looks like we're going into extra innings. The question now that we all have to ask ourselves is a 4.75% policy rate, is that enough? Or should it go into the 5-handle area? And John, you and I have discussed this before, but I have called this the RIP cycle, which is recession, inflation, and policy risk. The more the Fed has difficulty fighting inflation, the more they have to hike rates, the faster they go, the more likely they are to create a recession in 2023. So I agree with Mona. I do think that prices will start to moderate. I thought that this would already be happening at this point. The issue that we have here is that now we're seeing inflation move from the goods sector and permeate into the services sector. The problem with that is that when inflation starts to broaden, and that's the real problem, it's starting to broaden, it makes it very, very difficult for the Fed to hike because it gets embedded in inflation expectations. Clearly, we're seeing demand right now in the economy. Wages are high, you know, wage inflation is there, and people are able to afford these higher prices, but for how long? And that's going to be the question for 2023. So the faster rates go up now, the more likely there is to be something breaking in the economy in 2023, which is why the yield curve remains somewhat inverted.
Jim, you've got to the heart of it, and it's about where this Fed funds peaks. The move we're seeing at the front end of this curve right now, with twos up 21 basis points to 450, how we're pricing a terminal rate through next year. Jim, I think the question we've all got to ask is the one you're trying to get at. Just how much upside risk is there now to the terminal rate based on where we're priced this morning?
Well, if the way the Fed calculates this, and they measure this cost of fighting inflation in terms of the unemployment rate. So I'm going to work backwards on this. I'm going to say that it takes an unemployment rate north of 4.5%. Today, we're at 3.5% unemployment in order for us to start to really tame inflation and wage inflation. And as I continue to work backwards on this, then I have to say what policy rate is required to get the unemployment rate up into the 4.5% to 5% area. And I would argue that it's a policy rate that is somewhere between 5 and 5.5% beyond what the 4.75% is today. Now, I'm not making a forecast on this. I'm just doing a calculation on this, and I'm suggesting that unless something changes, it's going to take more rate hikes from the Fed to bring up the unemployment rate in order to tame wage inflation, which I believe they think is the source of a lot of this inflation.
Jim, stay close alongside Mona. Big moves in this market. Your equity market down by 2 percentage points on the S&P. At the front end of the curve, up 22 basis points on a 2-year to about 451. TK down in Washington. Tom, some big moves here on Wall Street.
John Ferro, thank you so much. And really interesting conversation there with Mona and Jim about these market moves. What it means for me is I'm trying to suggest a 1-hour conversation with the managing director of the International Monetary Fund. Her entourage says that's not going to happen, so let's cut it down to 20 minutes. Managing director, thank you so much for seeing us. I have a plan. Eric Martin briefed me over a beverage of my choice last night and gave me this beautiful plan of discussion. We're going to rip up the script, and we have to because of inflation. When you speak to your PhDs, when you speak to Gita Gopinath and the rest, and with your doctorate as well, do you have a character or understanding of this inflation? What is the makeup of this inflation that won't seem to go away?
The makeup is one, disruptions from Omicron, and they continue in China. Two, Russia's senseless war against Ukraine that has pushed energy and food prices up. We also are going to see some repositioning of supply chains that would have longer-term impact on cost structures. But right now, what we face is demand remains quite strong and supply has trouble meeting it. The most important task we have to secure our economies is to win the fight against inflation. And that means for central banks to show the resolve that is necessary. And why we need to do that? Why do we need to win this war? Because if we do not have price stability, we undermine prospects for growth, and because we hit incomes of people severely.
Things are moving quickly. The U.S. real yield, as Jim Caron of Morgan Stanley just mentioned, moves 10 basis points. The two-year yield moves, I believe, 18 basis points. Do you suggest, would the IMF suggest to central bankers, including Chairman Powell, that they need to slow down the dialogue and the certitude, the rhetoric, and extend the timeline out, even at sacrificing a higher inflation, to provide for financial stability?
What we are suggesting is that the Fed needs to continue to be data-driven. They need to look at the economy. They need to look at where the signals are in terms of are we reaching price stability or not. And then they need to look at the impact their decisions would have domestically, but also internationally. Let's remember, tighter financial conditions also mean stronger dollar, also mean capital outflows from emerging market and developing economies. Of course, the Fed is primarily focused on domestic conditions. The responsibility of the Fed is price stability in the United States. But also the Fed has been quite active to think of ways to support global stability, especially through extending swap lines to a large number of countries.
Give us an update on that right now. We talked to the people of the Green Book, the Financial Stability Book. What is the IMF's present tone on the quality of the liquidities in the market, given this inflation report this morning?
We have seen financial stability risks increasing, but we are still primarily concerned about inflation running out of control. If it maintains so stubborn as it has been so far, then the most significant risk we face is that inflation expectations de-anchor. And when they de-anchor, that means then pressure on wages to go up would fuel inflation from other directions. And then the job of the Fed would become harder, and it needs to tighten even more.
Two more questions very, very quickly here. You met yesterday with certain members of the British government, I believe a gentleman from the Bank of England and a beleaguered Chancellor of the Exchequer. Did you put them out in the proverbial American woodshed? I mean, give us the insight. No one's listening or watching right now. How did that bilat go with the two members of the United Kingdom?
It went really well. It was a very constructive meeting. We talked about the narrow path that the world economy has to walk on today, and how important it is not to make missteps out of this path and not to communicate in a way that may be more difficult. What I was very encouraged to see is that the two of them sitting together with a common purpose, the Chancellor talking about his intention to accelerate a projection of how he's going to anchor his budget in medium-term fiscal sustainability, and also his commitment for the Office for Budget Responsibility to come up with independent projections. That all tells us what we know, that the UK actually has strong institutions, and they do work even if at some point we may see some this
With those
misalignment.
comments, you'll be invited to the coronation. Dr. Gorgieva, thank you so much. Greatly appreciated. On this day of a surprise inflation in America, John Ferro, Kristalina Gorgieva.
TK, ugly on this side of things, that's for sure. Tom, thank you. Great work as always. In sum, ugly all around. The words of Mohammed Al-Arian just moments ago. Coming up on this program, The View from the White House. That's next.
If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target range for the federal funds rate should remain on the table.
That conversation coming up.
If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target range for the federal funds rate should remain on the table. However, if inflation starts to decline, I believe a slower pace of rate increases would be appropriate.
The Fed getting that green light to keep on hiking. Inflation ramping up the pressure on the Biden administration with just weeks to go until the midterms. For more, let's get to Josh Wingrove down in D.C. Josh, have they got to own this one?
I think they're going to try to squint hard and find whatever they can talk about, maybe that top line non-core number trending down and saying the Fed still has work to do. But this is bad news, of course, for Joe Biden and for Democrats. It's the last data that we're going to get before those midterm elections, where Democratic hopes have been kind of rising a little bit, that they would avoid a bloodbath that had been coming down the pipe 6 months or so ago, and still have a really close race for the Senate. The House is still looking favorable for Republicans. So this will give Republicans ammunition going into those final weeks of that campaign to say, look, prices are out of control, and you need to switch who's in power in Washington to do something about it. On the flip side, they will continue to point to that Inflation Reduction Act. We'll talk about the reducing or the lowering levels in drug pricing from that. Of course, that still takes time to kick in, and I suspect the Social Security bump that was announced this morning is also going to be emphasized by President Biden to remind voters, particularly the elderly voters, that they might get more money coming into them to deal with this. So that's the sort of top line, but it is as we've said, as all the guests have said, this is just a brutal print all around it that makes it brutal for Joe Biden.
What are the options on the table for them now? They're in this scrap with Saudi Arabia, the kingdom, over the last week or so on this OPEC Plus decision. What's left on the table for them?
Not a lot. We don't know what consequences President Biden has been referring to after that OPEC decision. We're looking for more on that. Of course, we continue to watch what, if anything, they will do with the SPR, where the ongoing release that they promised in the spring is sort of coming to an end. The question is, do they expand that or keep it going in any way to try to stabilize oil markets in particular? Other than that, there's no hope of any sort of bill or anything that kind of thing going through Congress before these midterms or after. So I think right now they just have to try to stay the course, or they're going to say that they have to stay the course and see where it goes. But as I say, they'll have to try to find a silver lining on this one, and they're going to have to look pretty hard.
Hey, Josh, thank you, buddy. As always, Josh Wingrove down in D.C. Tough to find a silver lining. That job is going to belong to Brian Deese of this administration, the National Economic Council Director. Brian's going to join us in about 20 minutes' time. Back with us for some final thoughts, Jim Karen, Mona Mahajan. Mona, thanks for being patient with us. You heard that Gorgieva interview, the IMF Managing Director. Should we have renewed concerns, increased concerns about financial stability, and how difficult will it be for this central bank to bring down inflation, address that with higher interest rates, and at the same time not cause a big problem in this market?
Yeah, I think it's now a higher tail risk than we had originally expected going into this print. And keep in mind, in the U.S., we haven't yet seen some of the instability we are seeing across the globe. Credit spreads here in the U.S. are relatively contained still. Yes, the inverted yield curve has been persistent, but it hasn't been exacerbated in magnitude over the past few weeks. We have seen relative stability across market and market functioning. So we'll be keeping an eye on that one. Keep in mind, as we continue these Fed rate hikes higher, perhaps through February, maybe even beyond, the question then becomes, there is a lag impact from those Fed rate hikes. We've now probably raised rates close to 400 basis points for the year. In 6 to 12 months' time, that will hit the real economy in a more meaningful way. Does this potential recession then become perhaps not deep, but maybe prolonged. And I think that's where the equity market adjustment may have to still yet be reflected. We are, of course, today seeing a larger impact, outsized impact, once again on the higher valuation, growth parts of the market, relatively less impact on the value and defensive parts of the market. I think that theme still has some legs in the months ahead as well. So both things to keep an eye out on. I think for now, the U.S. credit markets are functioning, but with these rapid rate increases, I think that's a tail risk we have to monitor.
That's the key word, functioning. Jim, for the bulls, we have a price problem. I get it, but the Fed's not going to care about that. Do we have a market functioning problem in fixed income?
So right now, I would say it's functioning. Liquidity conditions are certainly stressed, and you're seeing that with some risk premia of assets moving higher. And it also explains some of the gappy moves that we've been getting. But ultimately, when we think this through and we try to bring this forward, it all goes back down to what I think of as if this was a football match, it would be labor versus capital. Labor is at 5, capital is at 0, and essentially capital could be considered asset prices as well. And what we have to try to consider here is if the Fed is very serious about fighting inflation and getting wage inflation down, then there's a very difficult message that needs to go out to the U.S. public, which is that the labor market has to soften in order to get this inflation under control. Now, the more the Fed starts to hike rates, and to get to your point, John, in terms of the functioning of the markets, essentially, if the Fed is going to go 75 basis points in November, if they're going to go maybe 75 basis points in December, 50 to 75 in December, and they're going to get up to that 4.75% rate very quickly and maybe go higher, it is a question about a little bit of a pig through the python. These are a lot of rate hikes that are going through the markets over the past few months and going forward. It's going to take a toll at some point. It's always hard to figure out what's going to break or when that might actually happen, or even if that might actually happen. But the more the Fed does this at an accelerated pace, not only does it risk a recession in the future, but it does risk some type of liquidity breakdown at some point. And that's something that is just going to be an added risk premium that gets put into the markets that's going to weigh on asset prices.
Hey, Jim, it's good to catch up. Thanks for being with us this morning. Jim Karen, Mona Mahajan. Coming up, the morning calls, and later, a monster upside surprise on inflation. We'll catch up with JP Morgan's Tom Kennedy around the opening bell. The opening bell, 7 minutes away. Inflation coming in hot. Yields up, stocks down. We're down by 2% on S&P 500 futures, down by 2.9 on the Nasdaq. Here's some morning calls for you. First of all, this one from B of A upgrading Las Vegas Sands to neutral, pointing to an improving macro environment with Macau headwinds starting to fade. JP upgrading Colgate to overweight, expecting the company to maintain pricing power. And finally, Citi downgrading Amex to sell, warning investors about the potential fallout from a looming U.S. recession. That stock is down by more than 4%. Coming up, ugly inflation report, teeing up earnings season. JP Morgan's Tom Kennedy joining us at the opening bell. That opening bell is up next. 6-day losing streak is about to become 7. Equity futures deeply negative, 20 seconds away from the opening bell. Good morning to you. We're down 2% on the S&P 500. On the Nasdaq 100, down by 2.9%. On the Russell, the small caps down by more than 2%. Inflation coming in hot and sending this equity market down, down, down. In the bond market, yields up, up and away. Twos right the way through the curve. On a 10-year, up 16 basis points, back through 4%. On a 2-year, your 2-year yield this morning in America is up, and it's back through 450. When was the last time you could say that? 451 on the 2-year, up 22 basis points on the day. In the FX market, euro dollar, stronger dollar. Euro dollar 96 handle, 96.66. Dollar yen all over the place, 147 on my screen right now. And crude lower by 0.9% to about $86.50. In the equity market, around the open, about 30 seconds into this, we're down by more than 2%. On the S&P, on the Nasdaq, we're down by 2.9 percentage points. Markets feeling the pressure from inflation. Investors now shifting their focus to one thing:
earnings season.
Corporate earnings.
That is the next thing that the market has to focus on.
We're seeing some pretty bad earnings already.
We're going to look for guidance from CEOs and CFOs.
Investors are looking for outlook.
Recession talk.
A lot of companies have failed to provide outlook and any guidance and certainty.
We don't know yet how much they're going to come down.
How are they going to maintain margins?
It's the margins.
Profit margins.
Margin pressure. That's going to be the sticker shock, I think, coming out of these earnings.
The trouble still lies before us.
Is that the next shoe to drop? Joining us now is JP Morgan's Tom Kennedy. Tom, fantastic to catch up with you, buddy. It's been way too long. Let's start with the inflation report. It's 60 minutes old. Your thoughts, sir?
Yeah, good morning. This solidifies 75 basis points at the November meeting. The Fed is going to have to look at this inflation report and suggest that more tightening is necessary, even if that's a lagged effect on the economy. John, I try with my clients to give them long-term perspective about what could happen. I think you have to call it as it is. This is a hot labor print, a hot inflation print. The driver here is shelter. When and how is that going to roll over? At this point, when I get to talk to clients in our platform that are big real estate owners, they're starting to get substantial pushback in the commercial side of things and now in the residential side.
Their assessment of the Fed, Tom, in the last decision, in the minutes we saw yesterday, this quote: "The cost of taking too little action to bring down inflation likely outweighs the cost of taking too much action." Do you agree with that assessment?
I think that assessment is becoming more balanced. The Fed has tightened conditions in a historic fashion, John. We have never seen, absent a recession, financial conditions tighten the way they have in the last 9 months. It just takes time for that to filter through. Another thing in the minutes last night that wasn't really talked about as much is the Fed keeps ratcheting up the conversation about wage spirals. And when you start to look back to the Volcker era, those are the things that prompted monetary policy to be so tight then. This inflation report today, we can start to find seeds of, is that probability of a wage spiral? I think it's very low, but non-zero. I think it's going down. How did I get there? Core service inflation is not accelerating anymore if you remove shelter. And some of the more wage-sensitive sectors are not showing evidence of acceleration. The levels, John, are way too high. We know this. But if you're trying to find a silver lining, which is hard to do in this report, that's the one I would focus on.
I think a lot of people were hoping that we'd see more of that and that we'd go into this November Fed meeting and we'd lay the groundwork to have a downshift in rate hikes from 75 to 50, perhaps to 25. Tom, how do you think this changes that news conference with Chairman Powell in early November now?
Yeah, and the downshift, if there was a probability it would happen in November, is off the table. And the next conversation, I think, for the Fed will be, are we going 75 again in December? The downshift, John, to your point, just keeps getting pushed out. General consensus, it will happen at one point, right? And that's an easy thing to say. The further you get away from, or the higher you get from an estimated neutral rate.
You brought up a really good point, and it's how much work we've already done. The temptation on a morning like this morning, Tom, and you know it well, you see a number like that, you sort of run away with yourself, and you're like, they should go 100, 125, 150. Let's just wait and pause and think about what we've done already. 6 months, 300 basis points of tightening. Mortgage costs have more than doubled. I think the mortgage rate's got a 7 handle now in America, Tom. We've seen what's happened to financial conditions. We've seen what's happened to the US dollar. Can you tell me about the way you think about long variable lags in policy? All of that tightening in the pipeline already. When does that start to hit?
Yeah. The U.S. economy, John, has different lags, to your point. Investors and the Fed will focus on very short interest rate cycles, like the real estate market. As you mentioned, that market is getting hammered. Unaffordability is 07 all over again, and mortgage applications is the lowest we've ever seen. So desired effects are happening there. The reason folks will now focus on margins is that's a longer interest rate cycle. And that should be the next shoe that drops. Unfortunately, once you start to really pressure margins, that's when layoff activity starts to follow. I think this progress is just taking a little bit longer than we thought. The resiliency of the economy is there. Now, the question, John, you said this really nicely. When was the last time we saw a 2-year Treasury rate at 450?
Yeah.
For a long-term investor, these type of yields are wildly attractive because we're already seeing the desired effects of slowing growth. You can't slow growth forever. Eventually, that will mean something for inflation.
Well, Tom, let's talk about opportunity then. You look through the curve, 2s out to 30s. We can have a chat about duration. Then we can look out to credit risk, think about maybe IG, perhaps even dabbling in high yield. I mean, you can tell me. Where do you see the opportunities right now?
The screaming opportunity to me is in core, boring, traditionally unsexy fixed income, things like investment grade and municipal bonds. John, over the last 20, 25 years, the S&P 500 has annualized you about 6.5%, 7%. We can find those current yields in fixed income, less risk. So I think that's the screaming opportunity here. We are of the mindset that a recession in America is more likely than not next year. And I don't see that fully priced in the equity market. I don't see it fully priced in extended credit. So finding dislocation opportunities is our next best idea. And then monetizing volatility through structured notes. You can get downside protection and still get double-digit coupons. These are relatively defensive ways to aggregate wealth.
Tom, at the moment, I think that a lot of people like you are experiencing two different conversations with clients. One right now is the fog of war with inflation, what the Fed's going to do, where Fed funds peaks, and whether inflation comes down, and what should I do, like right now, with a time horizon of 5 minutes and maybe out to 6 months. Tom, the other conversation I'm hearing more of is whether this period is just an aberration and we go back to the playbook of pre-pandemic, low rates, low inflation, low growth, buy tech. You're going to see duration kick in again, yields go back down to, say, at one handle, maybe two. Tom, have you given thought about the long-term story, the destination here? Is this just an aberration, or is this a real regime change, a breakaway, a permanent break from the last 10 years?
No, I don't think it's a permanent break, Jonathan. There are, of course, going to be things that are different. And I think we have to, the most obvious one is we have to question how much confidence we can have in 2% inflation. But the longer run drivers of why interest rates have come down don't appear to have changed to me. And they're the ones we talk about all the time: aging demographics, technological advancement, the globalized connection. That deglobalization theme is getting a lot of attention. But any onshoring that happens to America is most likely to come in automation. And is that in the tech column, or is that in the deglobalization in the higher inflation conversation? So I do think rates, all else equal, are wildly high here, and over 3, 6, 12-month horizons need to come down. So I think that's the opportunity set for a long-term investor.
A final question then, and it's a short-term one, I guess. It's about 12 months away. I asked this question of Jim Kerr, Tom. I'd love your assessment of it. The upside risk to the terminal rate at the Fed, just how much upside risk is there now, given how much we've already priced in?
I mean, 5% after this morning is probably where the market will settle today of what terminal Fed funds will be. Upside, downside to that is, I think, will be warranted a true assessment after Q3 earnings. If earnings margins don't contract, Jonathan, we could easily reset that to 550. But if earnings and margins reset in a substantial way, we might have downside risk to that 5% number. So I guess a different way to answer your question is, I think we're symmetric on those risks of terminal relative to 475, 5%, which is what's in the price.
So, Tom, if we've priced that, and maybe we've more fully priced the Fed hiking cycle, how much have we priced the damage that will do to earnings?
Yeah, I think that's the piece that's missing, Jonathan. We're all focusing on what equity strategists are saying for earnings going forward, but that's just a number on a piece of paper. I think all of us have reset our earnings estimates somewhere to around, on the S&P 500, 200, 210. And now how much pain does the Fed have to inflict is whether that number should really be for 2023 earnings 180, or is 210 really likely? When we run our scenarios, Jonathan, downside risk to equities from here, it should be more limited. At 3,200, 3,300, you're pricing in a meaningful recession, a full-fledged recession. So that's going to be the awkward part, I think, for investors, at least in my community, of if we're not even seeing the recession, but the market has fully priced it, how do I match my investing know-how with my behavioral experience?
Hey, Tom, what a tough moment. Thomas Kennedy at JP Morgan. Tom, happy to share this morning with you. 60 minutes after another historic print for US inflation. A lot of stocks on the move. Equities down by 2%. BlackRock is down by about 3.8%. Down in Washington, I'm pleased to say, is Bloomberg's Shanali Basak. Shanali, you and I are going to talk about this one, and then we're going to have a busy morning tomorrow morning talking about Wall Street.
We sure are, John. We're going to talk about BlackRock first because those assets have gone below $8 trillion. That is less than what Wall Street was expecting. Earnings per share came in higher than expected here. But again, there are a lot of jitters in the market about what a falling market would mean for a firm like BlackRock. Now, fixed income flows were still healthy, but you did have equities under pressure, the retail business under pressure, and certain parts of the institutional business under pressure, but not as much as the retail business. Now, to your point, if you fast forward to tomorrow, the big asset management arms of the banks are not what we normally zero right in on, but it is another source of pressure that they'll have to contend with, mostly due to falling markets, lower fees, and their clients under pressure.
Shanali, looking forward to the conversation on Wall Street this morning. Pretty much every bank under the sun before the opening bow. Shanali Basak down in Washington will be all over that in the next 12 hours. Coming up on this program, a hot inflation surprise ramping up the pressure on the White House.
I don't think there will be a recession. If it is, it'll be a very slight recession. That is, we'll move down slightly.
The National Economic Council Director, Brian Deese, joining us next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Gedimus Simkis, ECB Governing Council member. That conversation at 10:20 a.m. Eastern, 3:20 p.m. in London. This is Bloomberg.
Live from New York City for our audience worldwide on TV and radio, White House National Economic Council Director Brian Deese joins us right now. Brian, fantastic to catch up with you, sir. Core CPI in America, 40-year high. This is the last inflation report before the midterms. Does the White House take any responsibility for this whatsoever?
Well, look, it's clear that inflation is a challenge. It is a global challenge affecting countries around the world. And I think the first and most important point to make is that the United States is in a better position than virtually any other country to address this challenge and do what is necessary to bring prices down without having to give up all of the economic gains that we have made. That continues to be our focus, and that will continue to be our focus until we get this job done.
The challenge is getting bigger. The president acknowledged this week the potential for a very slight recession. His words, his assessment. You briefed the president this week, Brian. Have your internal forecasts become more or less negative over the last few months?
Well, I think it's important to look at this monthly data in context. We are seeing some progress. If you look at annualized headline inflation over the last 3 months, it was about 2%. That's down from 11% in the prior quarter. Now, a lot of that is the significant reduction in energy prices and in gas prices at the pump. Obviously, economists tend to strip those out and look at core, but for typical American families, for workers, the reduction in gas prices by more than $1 a gallon in most places in the country is a meaningful and real sign of progress. At the same time, we're seeing some elements of a transition which we anticipated, but now focus on the work ahead. Shelter inflation represented more than half of core inflation for the last couple of months. And obviously, that's a place where we're going to have to look very carefully because there is a well-known understanding that data operates with a lag. And we're seeing some contemporaneous real-time evidence of sharp deceleration in rental price appreciation, sharp deceleration in home price appreciation. So that's going to be an area that we're going to have to stay very focused on here in the days and months
Brian,
ahead.
can you see why people get really frustrated with politicians? 12 months ago, 6 months ago, you would have said strip out gasoline and look at what's happening elsewhere. And now it's leave gasoline in because gasoline is coming down. Brian, can you see why people are very frustrated with the way the White House has navigated this issue?
No, look, I take issue with that characterization.
Why?
We always say that we look at the data because we always say that we look at the data in the aggregate, and there's a reason to look in the fullness of overall inflation and then also to look at elements of the core, like I just said. For typical American families, gas and food are big parts of their typical budget, and food prices in this report and in prior reports are moving up too fast, and that's something that we need to make more. We need to make more progress on. So we look at all of the data and understand the point about gas prices is just a very salient one. Your outlet, various others over the course of the spring spent a lot of time focused on the increase in gas prices and the impact that has on the economy, on consumer sentiment. Now that they're coming down, it's important to recognize that has an impact on the economy as well.
Well, more recently, they've been going back up, as well you know. It's why you've been very critical of Saudi Arabia over the last week. The president talked about consequences for Saudi Arabia. Brian, what consequences? What are they?
Well, I'm not going to get ahead of the president, and as he said, he will make those decisions and make those announcements when he is prepared to do so. I think our focus right now is on continuing to make that progress. If you look nationally right now, gas prices are still down about $1.10, $1.20 from their highs this summer. We're seeing some welcome moderation in certain areas of the country, the Midwest and California now. And we still face this historically large gap between the wholesale price that energy companies pay for refined products, gas, diesel, otherwise, and the retail price that consumers are paying. So that's a continued area of focus. Obviously, refinery and refinery capacity is an element of that. But that's one of many areas that we are working with the industry and trying to focus on what we can do from a practical perspective, from a policy perspective, to try to move the ball forward. On OPEC Plus, the NSC spokesperson John Kirby called the decision short-sighted, a short-sighted decision that benefited Russia. Can you understand why using the SPR as the strategic midterm reserve is a short-sighted decision that only leaves this country even more exposed to the whims of OPEC Plus next year? No, look, I disagree. We said that the OPEC decision was short-sighted precisely because the lack of supply and reliable supply continues to be the dominant challenge globally in energy markets. The lack of supply continues to be the dominant risk. And the use of the Strategic Petroleum Reserve in a historic but calibrated way starting last winter was designed to address that problem and to help have additional supply on the market during this transition and during a period where we knew Russian supply was coming off and U.S. producers were ramping up. That's why if you talk to most energy market analysts, they will point to the fact that that use of the Strategic Petroleum Reserve as a bridge as U.S. producers brought production back online, was one of the principal reasons that kept oil prices from moving up even more quickly over the course of the summer and into the fall. That's a prudent use of the asset as a transition as U.S. producers ramp up. You say it's a prudent use of the asset. Other people are very worried about this. You've drained the SPR to its lowest level in 4 decades. There's some accusation that you're putting the polls before America's energy security. Brian, the Saudis themselves said this morning that the U.S. requested a 1-month delay to the OPEC Plus output. I wonder why that would be. Brian, can you tell me whether you did ask the Saudis for a 1-month delay to that decision? Are they telling the truth? Look, we clearly communicated our views to OPEC members that we thought it was short-sighted for them to take the action that they were contemplating, and they announced. With respect to the Strategic Petroleum Reserve, this was a calibrated decision to address the real issues in the market. We talked to U.S. industry last winter. We identified that there was about a 1 million barrel a day gap between what they were producing this winter and what they said that they could get production to by late this fall. That 1 million barrel gap was what we calibrated to make the decision on the use of the Strategic Petroleum Reserve. And people should feel confident that the Strategic Petroleum Reserve continues to be an asset that we can deploy to address our economic and national security needs. That's always what has dictated the president's decision-making on this, and that's what will dictate his decision-making on this going forward. Brian, you didn't answer the question, so I'm going to ask it again. I'm going to share with you and share with our audience the quote from the Saudis this morning. The government of the Kingdom of Saudi Arabia would like to clarify that based on its belief in the importance of dialogue and exchange of views with its allies and partners outside of OPEC Plus regarding the situation in the oil markets, the government of the Kingdom clarified through its continuous consultation with the US administration that all economic analyses indicate that postponing the OPEC Plus decision for a month, according to what has been suggested, would have had negative economic consequences. Brian, again, it's a really straight question. Did you ask the Saudis to delay that decision for a month? Are they telling the truth or not? Look, I'm not going to get on air and disclose private conversations that members of our administration had. The Saudis have shared it with us. You've got the opportunity to say it's true or not. Is it true or not? What I will say clearly is that the communications that we've had with OPEC members and continuing have been based on our assessment of the economic circumstances of supply and demand in global oil markets. We disagree with the assessment in that statement that it was economically the right or necessary or appropriate thing to do to reduce production at a time where the lack of global supply on the market continues to be the predominant challenge in global energy markets. That has been and continues to be the motivation behind all of our engagements internationally. Again, they're suggesting it's a political one, that your strategy is political, that your effort to get energy prices is a one-month story. I understand what they're suggesting, and what I'm saying to you is that our strategy I understand what they are suggesting, and what I'm saying to you is that our strategy has always been grounded in an assessment of the economics of the situation and what is prudent for the global economy, for U.S. economy and U.S. families. So the way you would have some kind of viable energy policy from here is to make the decision as to whether what we're experiencing right now is a one-off shock or something more permanent, a one-off winter or something more permanent, a permanent shift away from Russian energy. Brian, which one is it? we're in a transition where we face some very immediate challenges, but absolutely energy markets globally and in the United States are going to go through a transition. We're never going to go back to the pre-pandemic or the pre-Putin invasion paradigm on energy policy. And that's frankly why, even as we have worked to address very immediate term issues, including helping the Europeans increase their reserves of natural gas going into this winter to try to address those immediate challenges, we have been focused on long-term prudent energy policy and providing incentives for U.S. producers of cleaner sources of energy to produce at scale and at speed that they've never done so before, and to do so in lower cost ways here in the United States so that we can be a reliable supplier of clean, low cost electricity to our industry, to our own consumers and families, and to the world. The United States, the Biden administration have focused on that. We prioritize that. And in fact, we have now legislated long-term incentives to drive exactly that kind of investment in the United States. And that's based on an understanding that we are going to continue to be in a historic energy transition, not just in the months ahead, but in the years ahead as well.
Brian, if this is not a one-off shock, if this is a permanent shift, can we complete the conversation by you telling me how it's a viable strategy, a sustainable approach to drain the SPR to a 4-decade low? If it's not about politics, why is that viable? Why is that strategy sustainable?
Appreciate the question. It's a mischaracterization of how we use the Strategic Petroleum Reserve. We announced a policy that was explicitly designed as a temporary bridge over the course of months, 180 million barrels, to bridge a temporary situation while U.S. producers were ramping up supply in the short term. Our long-term challenges around energy are about investing in increasing the supply of clean energy in the United States and globally at massive scale. Those require different policy tools, which is why we've enacted historic incentives, $370 billion in long-term incentives to increase investment in the United States. That's the right long-term policy solution. We can take short-term and temporary measures that are prudent and well-calibrated alongside long-term measures. That's what we've been doing.
Brian Deese, we appreciate your time this morning, sir. We really do. Thank you very much for choosing Bloomberg TV and Bloomberg Radio to have this conversation. Brian Deese there, the National Economic Council Director, following U.S. inflation, core inflation coming in at a 40-year high. Here's the trading diary for you. The next couple of days ahead going into the weekend. President Biden discussing infrastructure from LA at 2:15 Eastern time. Then on Friday, the big banks reporting earnings with results from JP Morgan, Morgan Stanley, Citi, Wells Fargo, all coming ahead of the opening bell. We get U.S. retail sales, UMich consumer sentiment survey, and finally, more from the Fed with George, Cook and Waller all on the agenda. Inflation coming in hot in America. Equities down and down hard, off by 1.3% on the S&P. The Nasdaq down by 2 percentage points. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.